I'm in jeans. 12K. Oh fuck, I knew that was a rug, man. Oh, the jeans got motion. Fed leaves rates unchanged. Safe. Bullish. I don't know how they've seen that when I'm watching this live. Fair enough. Let me see. So we're mega bullish. Let me check. Resume the bull run. Resume the fucking bull run. Yep. Resume the fucking bull run. Yep. Resume the fucking bull run. Let's go. Come on, chat. Resume the fucking bull run. W's in the fucking chat. W's in the fucking chat, bro. How did they even get that information without even seeing the thing? It's crazy. Jeans is flying. Come on, resume the fucking bull, mate. 64 mil. Priceless about to top 3M. How's Bitcoin looking? Bitcoin will give us cheeky shakeout. Guys, if you see anything, shout it out, please. Crypto Lemonade.
Surprised Techless is at 800, 730, and Valueless is at 130.
And now Techless is it's on belief, so it's likely to go higher.
That's wild. You think Valueless can come back or no?
No, not unless Pump announce anything. Pump announce buybacks, first thing I'm buying is Valueless.
I'm buying this PFP dip 77.
Yeah, guys, if you're looking for a long-term bag, PFP. I think it's a resume the bull run moment, personally. BTC not reacting the best, obviously. What you say, bro?
Oh, nothing.
Hi, I'm Ian, and I work for the...
The fuck is this?
Right, place the trade there, and it's been approximately 2 minutes and 54 seconds to lose 2.5 grand. plus that one. 6 grand down in fucking 3 minutes. Oh well, it'll loop back around though. I'm telling you, it's aggressive. We're not taking the loss here. Like we will loop. When you get these big spikes, you can do nothing but ignore it. And then naturally, we'd probably, by the time of the meeting, be coming back up to this level. It's just I could have got a much better entry, but I'm not doubling the size of my trade. I'm happy with the sizing. And I kind of believe that by the end of the meeting, to be honest, we'll be making a big fat pump. This is the very, very high volume time.
How the fuck did it nuke me before I even managed to? Probably gonna get rugged here by aped. Oh, fuck off. $64 million now for Uranus. Bro. $1 got like 200 and some K, bro. Clean fucking cook. And all we need is resume the fucking bull run, mate. Pump fund announces 100% buybacks. We do have 1 or 2 large sellers on chain. This bot as well. See grabs. You guys see grabs? President Trump says he heard Fed chair will cut rates in September. Where's that source? Oof, Grabs has actually got a little bit of motion on it. Casino's in, man. I'm gonna have to hop out. See Pelosi. That is funny, bro. You guys see Pelosi? Yeah, this is major. Oof. Oof. Excuse me. Let's go. Pelosi Act. Guys in the VC, you there? Yes.
Always.
You getting Pelosi Act?
Thought that was Tariffs.
It is flying.
Oh, wow.
30K.
Great call, bro.
Wow. Wow. Let's not do that. Thank you. Fuck, man. Platypus. Fuck. Yeah, I just replied. It's too late, innit?
The pump chart's coming down a little.
Yeah, I'm in MIRA. These guys are going for some kind. This is my magic TA prediction. Uptrend. Uptrend. 40. Here, 10 more minutes. I like this White House stuff fun. Everything aligns on Pump Fun. It's the right narrative. Whoa, utility coin. Wow. Wow, what the fuck, bruv? What did I miss? Oh my god. Utility coin just vamped it. It might just be a Twitter play. It might be a bunda. Migration player.
Holders are going up crazy on utility.
GM.
GM, bro.
Oh, Ryan.
What's up? You guys
400
cooking?
holders on utility.
Yeah, it's going nuts, isn't it? Hmm. Yeah, cooking, bro. It's been a crazy day in the trenches, bro. Absolutely crazy. Wow, 100K.
Here we go.
Oh, FOMC.
GDP
Utility
rose
at
at a
130. Okay.
1.2% pace in the first half of this
2x.
year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak.
Yo,
In the labor
utility
market,
sending.
conditions have
Utility
remained solid. Payroll job
205.
gains rose 150,000 per month over the past 3 months.
Utility
The unemployment rate at
sending boys.
4.1%
Let's get it.
remains
Damn.
and has stayed in a
Oh,
narrow
shit.
range over the past year.
I thought it was too
Take
high to get in
profits.
at
Take
80.
profits.
Continued to
What the
moderate,
heck?
outpacing inflation.
Take profits.
Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy.
Hello, everyone. Welcome.
We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get.
Wow, you guys see Huddle
at the September meeting.
It's legit.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic?
And the other one as well at 20.
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So, at the time of the last meeting, uncertainty had moved down a little bit, but it was
this thing's blasting, dude.
So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again.
there have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still, you know, a ways away from seeing where things settle down. We are clearly getting more and more information, and you know, I think at this point, people's estimates, our estimates, outside estimates of the likely, you know, effective level of tariffs is not moving around that much at this point. But at the same time, there are many.
Some guy absolutely raped the chart.
To resolve.
I'm waiting to
So I
see
think
that on
we
the
are
fucking
moving
Twitter
along.
later.
It doesn't feel like we're
8K you made.
Which one was
that process, and that's
which one's
not
the
for us
one
to
here on HODL?
judge,
I'm in both. I
feels
made
like
money on
there's
both.
Much more to come.
Yeah,
I
same.
reckon it's
you
the
know,
one
as
with a
well
nice
looking at.
image. 9 KOLs.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned,
Come
in my
on,
opening
man.
remarks,
Fuck's sake, bro.
economic
People in the trenches need
activity
to
data,
bid shit they
private
like,
domestic final
bro.
purchases, which we think is
A good meme.
narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in
Damn.
the case of GDP for the
I'm
first
holding anyway.
half, whereas it was 2.5 last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, you know, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, you know, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
You know, the main
Can't lie,
thing we
hodl
have to
coins
look
worth
now is
bidding
the
at the floor, you
unemployment
know?
rate, because if it's true that the, you know, demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, you know, as long as that puts the labor market in balance, the fact that it's getting.
What'd you say about 100 coins?
Hodl coins worth bidding at the floor.
Oh, I see, I see.
Suggestive of downside risks. So
It's actually a good meme, bro. That could have been PV, not gonna lie.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, you know, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were you know, thought carefully about this and put their positions out there. As I mentioned, you know, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be, at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to, slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The
OG
one big
Hollow
bill,
just went to
leaving aside the
millions.
adjectives, do you
Bit
expect
late,
it
bro.
to add stimulus to the economy in 2026, and would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, you know, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, you know, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, you know, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now, services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
You guys see Moonshot
I
Coin?
wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take
I'd
an
grab the
8%
floor.
reduction in headcount?
I'd grab the
and
floor on
R&D
this, bro.
spending as the administration has proposed?
So fucking,
Not gonna
so
comment
you've
on
been
the
blocked.
administration's proposal. I do think, as I've said,
I'd grab
I
the
think that
floor.
we're getting the data that we need to do our
I think
jobs.
he's missing the link.
And I
I'm
think
not
it's
100%
really
sure.
important that good data helps not just
Yeah,
the
I've
Fed,
seen it
helps
earlier. I
the government,
just
but
didn't
also
get
helps the
in.
private sector.
Missing the
You know,
link.
people in the economy.
Oh, well, I'm saying the link.
They use this
Missing the
data
link.
a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're showing coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
There's another one at 19K Moonshot.
Say that again?
The wait-and-see approach is giving...
Wait-and-see approach.
It's the same one.
For cutting
Yeah, that's what I was looking
waiting
at.
to see if the tariffs...
The chart's just moving funky.
So it's a wait-and-see approach.
Well, so that,
I'm
that's
in now.
policy's restrictive. When we start cutting, it'll go toward neutral.
Okay, this delay, though, where you're saying it's a one-time price
Yeah, I don't like the way the chart looks.
Oh, there's one with the link. There's one with the link. There's one with the link.
into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well,
Wait, what the fuck is going on?
It's not our policy stance. What may be giving
I still don't
some
like the way the
companies
chart
will
looks on
certainly
it.
be
I don't even know what the
taking
fuck's
advantage of
happening
the fact
right
of the
now.
tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can, and you saw it famously in the first administration of President Trump. During those tariffs, washing machines were tariffed, but
100 million.
dryers weren't. But what do you know?
Oh, 100 million coins in Uranus. 101.
Washing machines. So companies
This
will
Sweeney
often just
is
take
pumping.
across the street in a group. If you know,
Crazy. I got into that at
that'll happen. We don't see a
50K.
lot of that. I mean, what we see now is
NG
basically
to
the very
now it's back up.
beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow,
Gert finally bonded.
Additional tariffs have been in place since
Yeah, I've
February,
seen
and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe
Bagless made a new all-time high, 286.
I seen it.
Well, so the housing is a special case.
Bro, shit just doesn't last anymore. You think
you
you're
got-
going to be able to hold, next thing you know, you're getting formed.
You gotta be fast, bro.
And the rates that go into mortgages are longer term rates, like treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main
I've been
effect.
looking at United States dominant
There are things,
peg.
though, going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, but then that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's
Today's interview.
we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that
Come
you're looking
on,
for?
I've got
Do
one.
you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But you know, if you saw that the
See,
risks
Moonshot.
to the two goals were moving into balance,
I'm in.
were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So you know, that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So
Here we go,
moonshot. Get
moonshot.
back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? You know, it'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in.
25K now.
Before the next meeting. Will it be dispositive of that? You know, it's really hard to say. We don't make those decisions right now. So
29.
We'll have to see.
Well, I guess just in terms of inflation, though, for
32.
example, like will
Good call.
There we
some
go.
people would point to if it
Nice.
remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down
I think
closer to 2?
We'll look at everything. You know, it's as I mentioned. You know, a pretty reasonable base case is that this will be a one-time price increase, and in the end, we'll make sure that that's the case.
Oh,
We're
shit.
just trying to do that efficiently. And efficiently means getting the timing right, so we don't again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively.
Yeah, pretty much everything got to take across this click right now.
Yeah, if there's no KOLs, then no one buys the
Jones,
dips, bro.
Financial Times.
Just go
Just
to
a
zero.
question on the dollar. We've seen it decline
Ty, you longed Bitcoin?
this year. I was
Long
wondering if there's
pump.
been any discussion about that at the
Oh,
meetings
yeah.
and how,
Yeah, that shit's
to
on the
what
floor
degree
right
that may
now.
be complicating your attempts to get inflation back to target. Thank
So
you.
this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and you know the Treasury.
August is usually
shitty for crypto, so.
Speaks to this.
You guys see cut with hat?
It's not something.
Yep,
that's
looking
been
at
a
it, man.
topic of you know, major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
You know, we're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, you know, to be good and be able to rely on it. And we're not going to be able to substitute for that. But you know, if we have to make do with what we have. But I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, so I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
CCI.
Afternoon, Chair Powell. Maria Luisa
Sure
Caparro
looks
from
cloudy
Bloomberg
to see
News.
ya.
You mentioned a slowdown in consumer spending, and I
They
wanted
made a
to see
few of
if
them,
you could
so
walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had
Damn, it's all like
repeatedly
100K
forecasters, not
toppers
just
here,
us,
man.
had
What the
been
heck?
forecasting it would slow down.
No, we've had
Hell
10 mil
yeah.
runners
It
today,
finally
bro.
has. So I would
You
say,
had 10 mil runners?
Yeah.
if you talk to credit card companies, for example, they will tell you
Volume's
that
been
the consumer's
fucking
in solid
insane.
shape, and that
How
spending
long
is at a
ago?
healthy level. It's not
About
growing
half an hour, an
rapidly,
hour.
but it's at a healthy level, and delinquencies
before
are
you hopped on?
not a problem. You mentioned
Fuck, pump my
high-end delinquencies.
nose.
I don't know what to make of that. I read the same thing, but so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed.
What's
And,
this C
we're watching
coin?
it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on
Oh,
what my colleagues were
boy.
asking about this dissent, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report, we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close
Which
to
coin with
zero.
10 mil runner? I want to see if there's a
But
dip
the
on it.
unemployment rate is
Deep
still,
into it, maybe.
was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So that's it's in balance. Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor force is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things,
People were saying that MicroStrategy
look at wages
invested
are
in a coin,
gradually
but
cooling.
I don't know if it's valid.
Look
That's
at,
why. M-Ball.
vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you
The Bonk co-founder bought it at like
you have to see that there are downside risks.
2.5 mil as well, and sent it up to
But
6
you've
mil.
got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer.
Alright, guys, so if you're watching on stream, I'm gonna call it there. It's been a fucking insane day. I'm up like 60, so shit's fucking insane. Crazy runners. huge calls from like 10K, 15K or whatever, guys. I appreciate you guys for tuning in with me today. If you do want to join the trenches, you'll find the top link right here. You'll find it right here. We're 13,000 members. You can also join Blowfin as well. It's the best place to trade. My camera's run out of charge, so I'm going to charge it. And chillax. It's been a great day. I'm going to get some rest ready for tomorrow. I think tomorrow's going to be another amazing day. And also, guys, FOMC, the result, non-event pretty much. Should mean that the market overall stays strong. However, we are seeing a big spike in BTC dominance, but it's at resistance, and there's nothing but resistance above as well. You got resistance here as well. Even if we break, we have resistance here. So I don't expect anything crazy to happen. But if it does, I'm ready for it regardless, right? The trenches right now have been so good that I don't expect anything crazy. On the majors for meme coins, you'll see that the majors are pretty strong. Pump funds holding strong. Obviously, it didn't break out just here because we had this issue with BTC dominance. But I don't expect it to make any lows. Every time we get back down here, pump blast 300K into the chart. And there's also some market makers working with it again. You can see that TS wallet, this FT wallet is working with it. Anytime there's a big dip, he's buying the dip. And 6V as well. So they have a lot of market maker wallets working on the chart. You can also see majors as well. Majors took a slight pullback here. You can see Priceless, Cat Debts, and some others on that little pullback that we had, as well as Asteroid. But I'll be looking at getting into some of these majors because I do think that as the overall market gets bullish, we will see these very, very, very high. So keep an eye out. If you still got a lot of money on the sidelines, probably a good time to start making some bids. Market overall, as we said, is bullish. Fed hasn't cut rates. So any volatility short term, I do think will be short-lived. And yeah, guys, I'll see you same time tomorrow inside the trenches. Appreciate every single one of you guys. Guys in the VC, thank you guys as well. See you guys tomorrow. Peace.
Thanks, Todd.
Peace, man.